What if I told you there's a trading bot that could generate $1,000 daily, $7,000 weekly, or a staggering $30,000 every month? That's over $360,000 a year, more than most families earn working full-time jobs. It sounds too good to be true, doesn't it? These advanced trading bot systems, once reserved for the elite, are now becoming accessible to everyone, and they're turning this dream into reality. So how can you tap into this $1,000 daily passive income through automated trading? Well, you have to keep watching to find out. Today, we'll discuss the lies in the trading world that have been propagated for so long, perfected over the years, that they now look like the truth. Chances are, you've believed some of these truthful lies. Not because you're naive, but because they were designed to feel real, to feel safe, to feel right. And it's likely that very belief has been the invisible force holding you back from the level of financial success you know, deep down, is possible for you. Truthful lie number 1. There are sure strategies. You just have to find them to be a successful trader. You'd have to be an idiot to lose money on this trade, or at least that was what everyone thought. For years, the Swiss National Bank had promised to keep the Swiss franc, CHF, stable against the euro. They had set a floor price at 1.20 francs per euro and spent billions defending it. It was a guarantee, a safety net, a sure thing. Every trader in the Forex world saw a golden opportunity. The strategy was simple. Short the franc, go long on the euro, and if the price ever dipped close to 1.20, you'd buy the euro, sit back, and watch the Swiss National Bank push the price back up. It was easy. It was free money. It was the closest thing to a risk-free trade in Forex. So traders went all in. Some used 20x, 50x, even 100x leverage. Banks, hedge funds, retail traders. Everyone was betting against the Swiss franc. It had worked for years. It was foolproof. Until January 15th, 2015. The morning started like any other. Traders sipped coffee, checked their charts, and felt secure in their safe trades. At 9:30 a.m. Swiss time, without warning, without a single leaked rumor, the Swiss National Bank dropped a bombshell. They were abandoning the currency peg. One sentence, one decision. Chaos. The Swiss franc exploded, surging 30% against the euro in minutes. An unheard-of move in the Forex market. Screens were turning red in an instant. Stop losses failed. Liquidity evaporated. People who had been millionaires on paper moments earlier watched their accounts plummet to zero, then go negative. Because of leverage, many traders now owed their brokers money. They hadn't just lost their investments. They were in heavy debt. One trader in Poland opened his account, expecting a modest profit. Instead, he saw a negative balance of $300,000. Another trader in the UK, who had started with a $5,000 account, found himself staring at a $280,000 debt. Desperate, he called his broker begging for answers, but there was nothing they could do. These weren't isolated incidents. Alperi UK shut down overnight. FXCM barely survived, rescued by emergency bailouts. The Swiss hedge funds were completely wiped out. What was supposed to be a routine day of trading turned into a fast, chaotic, and devastating disaster. Traders were left stunned, their accounts in ruins, their confidence shattered. But the traders who lost everything weren't fools or reckless gamblers. They were experienced, disciplined, and intelligent traders. They had trusted a strategy that had worked for years, but the markets shifted, and their strategies failed to adapt. You might wonder what they could have done differently. Well, the harsh truth is that in moments like these, there's often little they could have done. Markets are unpredictable, and even the most reliable strategies can fail when extreme volatility strikes. But this doesn't mean they were powerless. The real lesson lies in risk management and diversification. As a trader, relying solely on trading as a source of income, or placing blind faith in a strategy, is dangerously precarious. You must always be ready for the unexpected, carefully control your exposure, and never risk more than you can afford to lose. In fact, it's crucial to never deposit all of your trading capital into your brokerage account. The financial market doesn't care about the past. It doesn't care about your wins, your losses, or your strategies. It only cares about now. The traders who survive long-term are the ones who never assume anything is risk-free. They manage risk. They prepare for the impossible, and they adapt. Truthful lie number 2. Trading money is easy money. Between 2017 and 2020, South Africa was swept up in a wave of promises, dreams of effortless wealth. Everywhere you looked, Instagram, Facebook, YouTube, self-proclaimed Forex kings flaunted their riches. Some boasted about AI-powered trading bots, software so advanced it could do all the work for you. No skills needed, no experience required. Just deposit your money and watch it grow. For many South Africans, especially young people grappling with an uncertain economy, it was an irresistible offer. A single deposit of 5,000 Rand, they were told, could turn into 50,000 Rand in just a few months. And why wouldn't they believe it? They saw the proof online. People just like them were posting screenshots of massive profits, celebrating new cars, luxury watches, and extravagant lifestyles. Forex trading had become more than just a financial opportunity. It was a cultural movement. One of the biggest names in this deception is Mirror Trading International, MTI. Founded in 2019, MTI positioned itself as the future of Forex trading. The company claimed to use AI-driven bots that could trade on behalf of investors, delivering consistent, high returns with little to no risk. And the numbers were staggering, up to 10% profit per month. For context, hedge funds and professional traders and investors would consider a 20% annual return an incredible year. Yet MTI convinced thousands of South Africans they could earn more than that in just 2 months. Early investors were paid out. People who joined first withdrew profits, flaunted their earnings online, and encouraged others to sign up. But the money wasn't from trading. There was no AI, no secret strategy, no magic formula. MTI was a Ponzi scheme, disguised as a golden opportunity. New investors' money was used to pay out earlier investors, keeping the illusion alive. As long as more people joined, the house of cards held together. But then the illusion shattered. And in December 2020, it all came crashing down. Overnight, CEO Johan Steinberg had vanished. He left South Africa without a trace, and thousands of people who thought they were on the path to financial freedom realized they had been scammed. MTI had stolen over $1 billion from investors, making it one of the largest financial frauds in South African history. Some invested their life savings, others convinced friends and family to join, believing they were sharing a once-in-a-lifetime opportunity. But instead of financial freedom, they watched it all vanish before their eyes. Authorities stepped in, investigations were launched, lawsuits were filed. But for many, it was too late. The money was gone. MTI wasn't the first scam. It wasn't even the only one operating at the time. Countless Forex Ponzi schemes emerge, each weaving the same seductive illusion. Flashing wealth, promising impossible returns, much like the enticing opening of this video. At first, they delivered, paying early investors just enough to fuel the illusion. But then, like a shadow at dawn, they vanished, leaving empty accounts and shattered trust. If the opening of this video grabbed your attention, then listen closely, because this is what you need to hear. Forex trading scams thrive on two things: greed and ignorance. If you've ever felt tempted by the promise of easy money, chances are it's because of your own greed. The lie that you can double your money in weeks feeds on greed, hope, desperation, and the fear of missing out. And for as long as you chase the dream of effortless wealth, there will always be someone waiting to exploit you. Even today, years after MTI collapsed, new Forex scams continue to pop up. Different names, different faces, but the same playbook. The rest of this video isn't just information. It's a revelation about the many lies you have been told about trading. So, the choice is yours. You can click away now, slip back into the comfortable illusion, or you can stay, open your mind, and uncover what most will never dare to see. If you're still here though, still watching, still searching for the truth, then please make sure you're subscribed to our channel, because this is only the beginning. Thank you. Now, let's get back to the video. Truthful lie number 3. Leverage is safe. Brokers. At first, it looked like just another Wall Street success story. Bill Hwang, a former prodigy of hedge fund legend Julian Robertson, was quietly building a financial empire. Through his firm, Archegos Capital, he amassed enormous positions in companies like Viacom CBS, Discovery, Baidu, and Tencent Music, without owning a single share. Instead, he used total return swaps, a high-risk financial instrument that allowed him to control billions in stock with just a fraction of the capital. The banks, Credit Suisse, Morgan Stanley, Goldman Sachs, kept lending him money, convinced Hwang had it all under control. And for a while, he did. The stock soared, profits grew, and his exposure ballooned to over $100 billion, built on just a few billion in actual funds. It was a house of cards, towering and glittering, but fragile. Then one decision changed everything. Viacom CBS, one of Archegos' largest holdings, announced a stock sale to raise capital. However, their investors didn't like it, and the stock began to drop. At first, it was just a little. For most traders, a small dip is nothing. But for someone leveraged to the extreme, even a slight drop is a death sentence. Hwang's banks panicked. Margin calls flooded in, but he had nothing left. There was no money to pay. The moment the banks realized Archegos couldn't cover its losses, the walls collapsed. Billions in stocks were dumped at once, triggering a market-wide meltdown. Viacom CBS collapsed by more than 50% in days. Discovery was wiped out. Baidu was also crushed. The stocks Hwang had controlled so effortlessly were now destroying him, and by the time the dust settled, Archegos Capital was dead. Hwang, once a secret king of Wall Street, lost everything in a matter of days. Of course, the banks suffered too. Credit Suisse alone lost $5.5 billion, one of the biggest trading losses in banking history. But here's the part that should send shivers down your spine. Hwang wasn't a bad trader, he had a working strategy. Yet he lost all that money. Hwang believed in his strategy, probably too much, so much that he stopped questioning, stopped adapting. He bet everything on being right, but the market doesn't care about confidence, it doesn't care about your past wins. Hwang wasn't the first to be devoured by leverage and overconfidence, and he won't be the last. History is filled with traders who thought they were in control, until the market, with ruthless precision, proved them wrong. Personally, I know this feeling all too well. I've been liquidated more times than I can count, chasing Bitcoin on margin. Leverage is tempting, it magnifies everything. Not just gains, but losses, risk, and downfall. And the most dangerous part is that your broker wants you to use it, while also believing you have control. They will tell you it's a tool to amplify your gains, but what they won't tell you is that it is also a weapon, one that can turn on you in an instant, while they win. Hwang believed he was playing it safe, but in reality, he was blindfolded on a tightrope with no safety net below. Our minds have a tendency to mistake luck for skill, to believe we can tame an untamable market. Most traders are convinced their strategy is foolproof, believing they've built an unshakable system, just like Hwang did. But the market doesn't care about your confidence or your plans. The moment ego takes the wheel, it all falls apart. Fast. It destroys those who fall for the tempting, truthful lie that leverage is safe. So, the next time you're tempted to crank up the leverage, remember Bill Wong, remember Archegos, and remember the $100 billion empire that vanished in days. Truthful lie. Number 4. More trades mean more profits. In the early 1990s, Nick Leeson was a rising star in the world of finance. A working-class kid from London, he had clawed his way into the elite world of investment banking, landing a job at Barings Bank, one of Britain's oldest and most prestigious financial institutions. By 1992, Leeson was sent to Singapore to run Barings' futures trading operations. He was young, confident, and hungry for success. And for a while, he was unstoppable. His trades were making millions for the bank and senior executives back in London, many of whom barely understood the complexity of derivatives trading, gave him full control. No oversight, no questions asked, just profits. Like all of us, Leeson had winning streaks and losing streaks. But unlike the disciplined ones who accept losses as part of the game, he refused to lose. And when one of his early trades went wrong, he found a way to hide the loss. He created a secret, unauthorized trading account where he dumped his losing trades, hoping he could make the money back before anyone noticed. At first, it seemed harmless. It was just a temporary setback. But then, the losses started growing, and instead of stopping, he doubled down. By 1994, Leeson's bad trades had spiraled out of control. Instead of cutting his losses, he started placing even bigger bets, hoping that one massive win would erase everything. He used more and more leverage, making riskier trades on Japanese futures contracts. He was no longer playing to win. He was now playing not to lose. And for a while, luck was on his side. At least until January 17, 1995. On that day, a devastating earthquake struck Kobe, Japan, and as with such events, the stock market plummeted. But Leeson had bet everything that Japanese markets would rise. Well, the market did the exact opposite. Overnight, his hidden losses exploded to $1.3 billion. There was no way to cover it up anymore. The truth was about to come out. Realizing he was finished, Leeson fled Singapore. By the time Barings Bank executives discovered the hole in their balance sheet, it was too late. One man's reckless overtrading had bankrupted an institution that had existed for 233 years. Barings was finished. The British government refused to bail it out, and within days, the bank was sold for just £1 to ING. Leeson was arrested in Germany and handed a 6.5-year prison sentence, marking his dramatic fall from being one of Asia's most influential traders to a fugitive in the blink of an eye. It's a fascinating idea, one that whispers to every trader, the more you trade, the more you'll win. But if you don't already know, let me tell you, the reality is far darker. More trades mean more risk, more exposure, more commissions, and a higher probability of mistakes. The market doesn't reward hyperactivity. It rewards patience, strategy, and the discipline to cut losses before they cut you. The market doesn't care how many trades you make. It only cares how many you survive. And overtrading. It's a surefire way to limit your chances of survival. Of course, the trading world is filled with countless more lies, and if you're curious to uncover them, the linked video dives deeper into more of the truthful lies of the trading world. If you found this video helpful, don't forget to like, subscribe, and most importantly, if you'd like to see more of this video, just drop part 2 in the comments below. Thanks for watching, and until next time, may the trend be with you.